Welcome to the Deep Dive. We're your guide, trying to cut through all the noise around earnings calls, the ones that really move the markets.
Yeah, getting to the story behind the numbers.
Exactly. And today we're digging into a really interesting recent call from a major industrial player. They've been making some big moves lately. You want to look past just the headlines, uncover the strategy shifts, the trends underneath, and figure out why the market reacted so strongly.
Oh, this call definitely got the market's attention. Fast and sharp reaction, but like usual, that immediate reaction doesn't always capture the whole picture. So we'll try and unravel that, see what really drove the initial sentiment, and what management's actually signaling for the longer term. Might be some surprises in there.
Okay, let's jump right in. The headline numbers for the second quarter. Just looking at the results, how did they do?
Well, on paper, pretty strong, actually. Revenue came in at $7.03 billion. That was comfortably ahead of what analysts were expecting.
Yeah.
And adjusted EPS, earnings per share, that was $2.95, also beat estimates just by a little bit. And maybe the key thing, organic sales growth, stripping out acquisitions and currency stuff, was solid, 8% year over year.
8% organic. So yeah, good top line, good bottom line beat. Sounds positive. If I just saw those numbers flash across the screen, I'd think, okay, stock's probably up. But that's not what happened, right? What was the market's reaction on the day?
Yeah, it was almost the exact opposite, a really stark contrast. Despite beating on revenue, beating on earnings, the stock pulled back significantly right after the call started.
Right away.
Pretty much. Shares dropped, about 6.8% in the first half hour, and they closed the day down over 7%. And what really jumps out is the volume. Trading volume was huge, 3 times the average. That kind of immediate sharp drop on heavy volume tells you something, right? It suggests the market wasn't just looking at Q2. They were laser focused on the forward-looking stuff, the guidance.
It's like getting a great report card, but then hearing the next semester is going to be way tougher.
It's exactly like that. Sudden panic.
Okay, so that's the puzzle. Let's unpack it. What were the highlights financially, operationally, and crucially, what was in that guidance that seemed to, spook everyone despite the good Q2?
Well, operationally, they did hit a record segment margin, 23.9%, which is impressive. That's up 20 basis points from last year. So 0.2% doesn't sound like a lot, maybe, but it shows they're managing costs well, getting good pricing, even with challenges out there.
Right. Execution matters.
Definitely. And free cash flow look healthy, too. $716 million for the quarter. These are good signs, operationally speaking.
So managing the shop well. But the growth story, you mentioned data centers, aerospace. What were the real engines here? What did the numbers show?
Yeah, this is where things get really interesting. The Electrical Americas segment was, it was on fire.
Okay.
Data center orders specifically jumped 55% year over year, 55%. And revenue from data centers was up 50%. I mean, that's just incredible acceleration, huge demand. And the backlog in just that segment grew 17%. It hit a new all-time record, $11.4 billion.
$11.4 billion. Backlog. That's future revenue, basically locked in.
Exactly. It gives them amazing visibility well into 2025, maybe even further out. Aerospace was strong too. Orders up 10%, backlog up 16%. And the company's overall book-to-bill was 1.1. Healthy. Means more orders coming in than they're shipping out. Demand is strong.
So the core electrical side, especially linked to data centers and aerospace, are booming. But it's never all sunshine, is it? Were there headwinds, any weak spots they mentioned?
That's right. Yeah, it wasn't a perfect picture across every single business unit. Their vehicle business, for instance, saw sales drop 8%, mostly tied to weakness in the North American truck market. And their e-mobility segment, related but different, also had revenue down 4% and importantly posted a $10 million operating loss. Yeah. So management was upfront about it. They flagged those vehicle market issues and also some drag from foreign exchange rates as impacting the outlet.
Okay, so soaring growth in some key areas, but definite pockets of weakness dragging things down a bit, which makes this next part interesting. They actually raised their full-year guidance, right, despite those headwinds.
They did.
How does that connect with the market freaking out?
This is it. This is the absolute core of why the market reacted negatively, I think. Yes, they raised the full-year adjusted EPS outlook. The midpoint now suggests, 12% growth year over year? Pretty good.
Yeah.
They also nudged up their guidance for full-year organic sales growth and segment margins, all positive signals for the full year.
So far, so good.
But The critical thing, the number the market jumped on, was the third quarter guidance, specifically the adjusted EPS guide for Q3. The midpoint of their Q3 range came in about 2% below what the street was expecting.
Ah, okay. Only 2%, but a miss is a miss in the short term.
Exactly. Even a relatively small miss on the very next quarter's forecast. Combine that with management talking about ongoing heavy investments back into the business, plus those lingering macro worries in certain spots. That seemed to be the trigger, the main catalyst for that immediate sell-off.
It really is that, what have you done for me lately? Or rather, what will you do for me next quarter? Mentality sometimes.
It often is, especially with high growth or highly valued names.
So that slight Q3 miss,
Yeah.
it feels a bit disproportionate given the strong Q2 and the raised full-year view. Is there a chance management's just being conservative here, sandbagging? Or does the market see a real crack?
That's a great question. And honestly, it's probably what analysts are debating right now. Could be a bit of both. Maybe they are being cautious, setting a lower bar they can hopefully beat. Happens all the time. But the market, especially right now, it's just hypersensitive to any hint of slowing momentum, even if it looks temporary. So the vulnerability the market sees might not be in the long-term story, but just in that immediate next quarter earnings power, given the spending and the softness in trucks.
It highlights that tension between short-term trading and long-term investing strategy.
Absolutely.
And speaking of strategy, they've been really active. Acquisitions, partnerships, clearly trying to double down on those high-growth areas.
Yeah.
What were the main news they talked about?
Oh, yeah. They are definitely not standing still. So it feels like a real pivot moment.
Yeah.
They announced deals to buy two companies. One is Ultra PCS. They do aerospace safety systems. That gets them more into defense, which is usually pretty stable.
Mm-hmm.
But maybe more strategically important, they're buying resilient power systems. These guys focus on solid-state DC transformers.
DC transformers.
Oh.
Why is that crucial?
Well, think about AI data centers. They need huge amounts of power, and increasingly, they run more efficiently on DC, direct current. But our grids are mostly AC, alternating current. These solid-state DC transformers are like the crucial translators, the smart tech needed to efficiently manage power conversion and distribution for these massive AI operations. It's foundational tech for that build-out.
Got it. So positioning themselves right in the guts of the AI power infrastructure.
Exactly. And they also closed the Fibrebond deal, that's modular power solutions, which added another $1.2 billion to their backlog right away. So yeah, all these moves are clearly steering the ship towards those higher growth, hopefully higher margin areas, really pushing to become more of a pure play power management company.
And not just acquisitions, right? There were some interesting partnerships mentioned too.
Definitely. That adds another layer to the strategy. They highlighted working with NVIDIA.
Okay, that's a big name.
Huge validation, working together on transforming data center infrastructure. They're also collaborating with Siemens Energy on off-grid power solutions for data centers. Think about needing reliable power even if the main grid has issues. Decentralized power is key.
Makes sense for critical infrastructure.
And also partnering with ChargePoint on integrated EV charging solutions globally. So hitting the electric vehicle angle too. Management kind of wrapped it all up under this theme of the AI era grid redesign, positioning the company as central to managing power all the way from the big utility down to the individual chip in the data center or the charger for your car, building the electrical backbone for what's next.
Okay, so when you lay out the strategy like that, it sounds incredibly strong. A clear vision for long-term growth, hitting all the right buzzwords, but seemingly with substance behind it.
Right. And that's what makes the market reaction so, well, fascinating. That stark contrast we talked about. You have this immediate sharp sell-off, high volume. You even saw a jump in bearish options activity, people betting the stock would fall further, like buying those September 2025 $330 puts. It strongly suggests traders just latched onto that one data point, the Q3 EPS guide miss.
Ignoring the Q2 beat, ignoring the raised full year, ignoring the record backlog.
And ignoring the whole long-term strategic narrative they laid out. Yeah, it seems that way.
So a classic case of the market missing the forest for the trees, or at least the short-term traders did.
Precisely. Because if you connect it back, management was talking very confidently about this multi-year electrification and reindustrialization super cycle. This isn't just hype. It's about the huge shift to electrify everything, transport, industry, and bringing manufacturing back. They want to provide the power gear for all of that. And remember, just weeks before the call, all the positive news flow, especially those AI data center partnerships, had actually pushed the stock to a new all-time high.
Right, so there was significant positive momentum going into the call.
Which makes that 7% drop even more jarring in context.
Okay, so this brings us to the big question for anyone looking at this company now. Was that drop just a temporary blip, a knee-jerk reaction? Or could it signal something deeper, some underlying issue the market sniffed out?
That's the million-dollar question indeed. What's really telling, I think, is how the sell-side analysts reacted. The professionals who cover the stock day in, day out.
What do they do?
By and large, they stuck to their guns. They mostly maintained their positive ratings, the outperforms, the buys. Sure, some trimmed their price targets a little, maybe 2%, 4%, but they didn't fundamentally change their tune. They largely reinforced that long-term story. Electrical supercycle intact.
So the pros mostly kept the faith in the long-term thesis.
Pretty much. And then you had buy-side managers, investors, and some media framing it as a potential buy-the-dip moment, especially if you believe in that data center power story. Given the strategic moves, those huge backlogs, the solid execution in electrical Americas, their conviction seems pretty high.
And the balance sheet helps there too, right? Strong cash flow, planned buybacks.
Exactly. That $716 million in free cash flow is healthy. And planning to buy back $2 billion to $2.4 billion of their own stock in 2025, that signals management thinks the shares are undervalued. It's a vote of confidence.
So despite the whiplash on earnings day, a lot of the institutional conviction seems solid. Looking ahead, what should people be watching for? What are the next potential catalysts?
Yeah, the underlying story is this transformation, right? From a diversified industrial to a focused power management leader, riding these big secular waves, electrification, AI, reindustrialization, key things to watch. Q3 results, obviously. That's late October. That's the next big check-in. Then getting regulatory approvals for those acquisitions, Ultra PCS and Resilient Power. That could happen by Q4 and would make the strategy more concrete, and maybe the biggest one. They have an investor day planned for November.
Ah, those can be important.
Very. They're expected to unveil their 2030 carbon reduction goals, which is important for ESG investors, but critically, also an expanded AI data center product offering. These events could definitely help shift the market's focus back to that long-term growth picture, away from just the Q3 guide. It's a narrative that will unfold over time.
All right, this is the deep dive, and you know what time it is? Our This Is Not Financial Advice segment. Time to pitch an outrageous but maybe plausible trade idea based on everything we've just discussed.
Okay, well, given what seems like a perhaps overblown market reaction to what was actually a pretty nuanced call with a lot of underlying strength, you definitely see a potential disconnect there. Short-term gloom versus arguably strong long-term prospects.
Exactly my thinking. The stock gets hammered, down over 7%, wipes out gains that were built on that AI data center excitement. But, as we've laid out, the actual story around data centers, electrification, aerospace looks stronger than ever. Tangible orders, record backlogs, feels like an overreaction.
So for someone who buys into that underlying strength, who thinks the fundamentals will win out over that initial sentiment, maybe there's an opportunity.
Okay, here's a thought, a bullish idea, using options to potentially capture a rebound. What about looking at a longer dated call option? Say, buying the September 2025 $360 call.
Okay, why that specific strike and date?
Well, the stock closed around $384 before the drop, right? And was trading near $382 just before the call started. A move back towards, let's say, even just $370 or $380 would be a pretty significant recovery. This trade is basically betting that the market's initial, maybe emotional reaction fades, and a more rational look at the fundamentals kicks in, especially with the data center strength confirmed and their strategic positioning.
So betting on a reversal towards those recent highs, driven by a correction of that overreaction.
Yeah. It's a calculated gamble that the market figures out. It threw the baby out with the bathwater, and the price snaps back relatively quickly.
And using a call option like that aims to leverage that potential upside, maybe taking advantage of the higher implied volatility that often comes after a sharp drop. It's definitely a riskier play, tailored for someone who genuinely believes the market got this one wrong in the short term.
Okay, so wrapping up this deep dive, the market clearly reacted very strongly, very negatively to that Q3 guidance. But underneath that, the company actually delivered impressive Q2 results, locked in record backlogs, and showed they're aggressively pivoting towards these huge growth areas like AI data centers and electrification.
Yeah, the long-term story seems intact. A company positioning itself right in the middle of these multi-year growth cycles, using acquisitions, partnerships to really strengthen its position in critical power management. They're not just riding the wave, they're helping build the infrastructure for it.
So we've dug into the numbers, the strategy, the market's reaction, even floated a speculative trade idea.
And remember, our goal here is just to help you understand the full picture, not just the headlines you might see flashing by. We always encourage you to do your own research, form your own conclusions.
That's it for this deep dive.
We hope this analysis gave you some valuable insights to think about.
Join us next time as we dive into another market-moving earnings call.
Until then, stay informed and definitely think critically.